So what I thought I'd do before we take a break is have a look at some of the issues around accounting and the GFC, which happened a few years back. And that's starting to get a little bit, it sort of seems like yesterday, but when you look at it, it's 6, 7, not 8 years ago, but 6 or 7 years ago, that's starting to get a little bit back in time. But it's useful sort of just bringing up one particular point because it gets at some issues that are surrounding financial instruments and the accounting for financial instruments. So what we're going to look at today is actually on a company, an investment bank. Some of you guys may have heard of it, called Bear Stearns, that had some problems, to put it mildly. So as a former investment bank, just over 6 years ago, seems not that long ago, just over 6 years ago, it was bought by JP Morgan Chase for $2 a share. Now, its previous trading high over the weeks, sort of the year prior to that, was upwards of $130. So, it's had quite a dramatic fall from grace. Now, to give you a rough idea, because I was keeping an eye on this when it happened, but Macquarie, well, it's now a group, but at the time, Macquarie Bank, it nearly hit $100 a share in Australia. It was like 99 point something. At one point in time during the GFC, it hit round about, I think it was about $16 a share. So I mean, if like its share price got hit pretty hard. It has bounced back a little bit, but banks suffered quite dramatically during that period of time. Now, to give you an idea, just talk a little bit about it. Bear Stearns' accounts, or at least sort of leading into that period of time, you're looking at around about $400 billion in assets. So, it's not a small business. Now, close to half of that, not quite half, but close to half of that was some sort of marketable security. For argument's sake, we don't have to talk about the details of the security. Some of them are obviously quite complex, but the idea is they had quite a lot of marketable securities in other companies in various financial instruments. Now, the equity in the business, and this is the issue around a lot of investment banks. I mean, Babcock and Brown here went under, and they were quite heavily leveraged. But behind those $400 billion in assets were around about $11 billion in equity, which means close to $390 billion of that business was debt financed in some way, shape or form. Now, if you think about, I haven't actually worked out the leverage from that, but I mean, that's quite heavily leveraged up. Now, there are good sides to leverage. If you're making money, if you make a 1% return on assets, so if they were to make $4 billion, so quite a small profit, you make $4 billion, that's what, like a 30% return on equity? Like, that's a substantial return, and shareholders are obviously pretty happy with that. Now, the flip side to that is if you make a 1% loss on your asset, so asset values for whatever reason go down by a little bit, if you go down by 1% on your, like if your return on assets is negative 1%, you've wiped out a third of your equity. If your return on assets is negative 3% in this situation, you have pretty much completely wiped out your equity in the business. Like, the business is effectively gone. So kind of sensitive to losses, not just kind of sensitive, really sensitive to losses. Somewhat leveraged. I should have really thought about where that white spot came in, but it doesn't matter. Now, the thing I just wanted to talk about, because it leads into this concern around fair value accounting, and some of the commentary post-GFC was actually not blaming mortgage brokers for lending people money who probably shouldn't have been lent money. It wasn't blaming banks for being sort of implicit in that. It was actually blaming accounting and the accounting rules around fair value accounting for a lot of financial securities. Because what the issue is with fair value accounting, and we've come across fair value accounting before. We've come across it with agricultural assets. Some financial instruments, and we haven't talked a lot about them, get fair value accounted. Now, the idea behind fair value accounting is if the value of something goes up, you pick up that change. So you show the change in the assets and you pick up that gain through profit. If something goes down in value, You pick up that change going down in the assets, so you take the assets down, and you pick up that change in loss. So you're actually constantly adjusting your balance sheet to what's going on, and you're picking up all those effects in profit or loss. Now, for some of these things, and this is the argument some of the people in the banking industry and a lot of the criticism around it is, if you intend to sell those assets, or if you're holding those things to sell, that makes sense, because you're picking up those movements going through. If you're holding them, you want to sell them, and you're showing the gains and losses over time. But if you have no intention to sell, if you intend to hold on to this for the longer term, it may not necessarily be good for people to be aware that these things are changing in value. So I mean, the kind of equivalent, and you know, I'm not in this position, and look, maybe some of you guys are, but I probably has it not. But you hear a lot of people talking about, you know, house prices, and you know, if you're living in your house and your house price goes up in value, do you need to know on a daily basis how much your house is worth? Just imagine you did own a house. I mean, some of you may well be or an apartment. Some of you may well be in this situation. Do you think you need to know how much your house is worth every single day? Do you think you need to know every sort of month or so how much it's worth? You know, if you intend to live there, and that's what you know, the family home, you're intending to live there, it doesn't really make a lot of sense to have to worry about what those values are, because you're not intending to sell, so who really cares? And that's kind of the argument put forward here, that if you're not intending to sell, if you're not intending to get rid of this particular instrument, it doesn't matter sort of minute by minute or day by day or month by month what those values are. On the flip side to that argument is this idea of transparency, that should investors be aware that you're holding something which has dramatically declined in value, and would that help them make their decisions? So it's not an easy argument, and just, we're not going to go into a huge amount of detail about this argument, but it is something to be aware of, that there's sometimes use in knowing information, but there's sometimes use in actually not knowing information, and you can cause a problem by telling people stuff. There's actually sometimes a good thing to not let people be aware of the situation, because you can actually induce a problem by having them be made aware of it. Now, repurchase agreements. Now this is an example of where what was a potential cause to a systemic failure in the US financial system. Has anyone heard of repurchase agreements? Possibly in finance, maybe not. So, I mean, look, this is going to be a gross simplification of things, but what repurchase agreements are, they're actually a way of financing on in this particular case, on a very short-term basis. So, I need another volunteer. Again, you have to hold a water bottle for about 30 seconds. So it's not, again, an onerous thing. Really? There we go. Sorry, what's your name? Chun. Okay. So what are, in essence, and this is, again, a gross simplification, repurchase agreement, and the way that Bear was using it, and it was quite common at the time, is in effect overnight lending. So I could go to a bank to get finance, and you know, if you go to get a mortgage on a house, 25, 30 years. You know, the bank will do good checks on you, make sure things are okay. They may or may not lend to you. Repurchase agreement is in effect, imagine this is some sort of security. So let's just say a normal equity instrument. Actually, let's just call it a water bottle. I will sell this water bottle to Jun for $1, and with an agreement that he will sell it back to me for $1.01 tomorrow. Now, I don't know how that works out in terms of an implicit annual interest rate, but that slight margin that he's selling it back to me for, so he's making 1 cent on a day. Now, that's like 1%, a daily rate of 1%, which is probably a little bit high. But he's making a small, that margin is the effective interest rate that he's getting, or effectively the interest rate he's getting on it. Now, because it's done on a 24-hour basis, so basically I'll borrow from him overnight. Now, the next day comes and it's like, okay, I buy this back from him, but I don't obviously have, you know, $1 billion or so sitting around there to buy it off him. And so I basically finance that repurchase through lending it back to him. And you'll have a small rate on top of that, and we just keep that cycle going every single day. That works if he trusts me. and the business is going well and things look to be okay. Where it fell apart here was that at some point Jun heard issues that were going on in my business and went, nah, we're done here. I'm not actually going to refinance this agreement. You got to pay me for that last one that we set up, but I'm not going to be financing you again. That means I've suddenly got to come up with, and in their case it wasn't all of their debt, but it was not a small part. You suddenly got to come up with billions of dollars pretty much like that. And that's not an easy thing to do. They didn't have the cash sitting there, so that means they're going to have to start dumping these securities to realize cash, which I can pay Jun and the various other parties in the situation. What happens when you start dumping securities into the market to the value of those securities? Yeah, it drops. If you're starting a fire sale, if you're starting to drop things into a market in large quantities, that is going to depress market prices. And if they'd gone under, that basically would have meant that all those securities would have been pushed into the market. So if they went under, virtually all of these securities would become available for sale and pushed into the market at prices that would have forced all securities firms to mark down their assets in what surely might have led to the financial equivalent of mutually assured destruction. That is a really interesting book, that one. It's on their collapse. I mean, it is quite long, so you probably don't have the time in the next few weeks. But if you're interested in these sort of things and sort of some of the history about what happens with companies, that is certainly a book worth reading. But what they're getting at is fair value accounting, because I start to have problems. I'm starting to sell stock and sell various securities. But you have some of those same securities in those same companies, and then that means the value of yours, because you're fair value accounting, you've got to mark those assets down. That may put you in trouble with your lenders. So you start having to sell to figure out your lenders. That means you're in trouble now because your assets are going down in value. You've got to sort out them, and that just spreads. And that is the systemic failure that they were talking about, which is why the US government stepped in and to try to shore this system up, because literally the whole thing could have imploded. Does it create moral hazard in that space? And absolutely it does. So that's that idea of too big to fail. Because if you're too big, if you go under, you could actually cause widespread damage to the entire financial system. And that's what they were worried about. So anyway, on that positive and cheery note, that didn't happen. We're still here and alive and kicking. So we'll take a break for a couple of minutes and come back and get into the heavy lifting in relation to derivatives.